All right, let's talk about OXY. Occidental Petroleum just dropped its latest earnings report, and honestly, at first glance, the numbers are a little weird. How in the world does a company smash its profit goals but miss its sales target by almost $1 billion? It seems kind of backwards, right? Well, let's dive in and break it down.
So you've got this split personality in the numbers. On one side, you have this huge win. Earnings per share came in at 31 cents when everyone was only expecting 18. That's a massive beat. But then, you look at the other side, and whoa, revenue was only $5.1 billion when the experts were calling for over $6 billion. That's a pretty big miss.
Okay, so there it is, the big question. How do you make more profit with less money coming in the door? It just doesn't seem to add up. But the answer, and it's a fascinating one, isn't just about this one quarter. It's about a huge strategic shift Oxy has been making behind the scenes.
To really get what they did, you first have to understand the world they were living in. And trust me, it was not an easy year for them.
So think about the challenges they were up against. Oil prices, they dropped 14% compared to the year before. Right there, that explains why their revenue was down. But, and this is the really incredible part, even with less money coming in from selling oil, Oxy still managed to generate $4.3 billion in free cash flow. That's the cash they have left after paying all the bills. That kind of financial strength, that's the secret sauce to this whole story.
So, the question is, how did they do it? They didn't just hunker down and hope for the best. Nope, they had a really clear two-part plan to sail right through the storm. Let's get into exactly what that plan was.
Okay, so Oxy's big pivot really came down to two things. First, they got laser-focused. They sold off their entire chemicals business, OxyChem, so they could pour everything they had into their most profitable assets, oil and gas. And second, they got lean. They went on a company-wide mission to cut costs everywhere and squeeze every last drop of value out of every single dollar they spent.
And look, this wasn't some panic move. The CEO, Vicky Holub, made it super clear this was a deliberate step. The goal was dead simple: shore up to finances and build the absolute strongest oil and gas portfolio Oxy has ever had. Basically, they were building a leaner, meaner, and way more focused machine. All right, so that was the plan. The big question is, did it actually work? Well, let's just say the results are pretty stunning. This is where you see the strategy really start to pay off. Check this out. While they were actually spending less than they had budgeted, Oxy went and set a new company record for production. We're talking over 1.4 million barrels of oil equivalent every single day. That is literally the definition of efficiency, making more stuff for less money. It's incredible.
And the amount of money they saved? It's just massive. Since 2023, they've managed to find $2 billion in savings every single year just from their oil and gas business. That's not just, cutting back on office supplies. That is a fundamental re-engineering of how they do business.
So what do you do with all that extra cash you get from selling a business and cutting costs? Well, Oxy went to war with its debt, and in just 20 months, they wiped out an unbelievable $13.9 billion of it. And you can see just how dramatic that is right here on this chart. Their main debt load has just plummeted down to around $15 billion. And they're not even done yet. They're aiming to get it even lower. For OXY, this wasn't just some item on a to-do list. Fixing their balance sheet was priority number one, period.
So what's the bottom line for shareholders? Well, it's pretty good news. The company is now in such a strong position that the board just raised the quarterly dividend by 8%. Plus, they're keeping share buybacks on the table. This is what all that hard work and discipline was for, delivering real returns back to investors.
But hey, this wasn't just a one-and-done kind of deal. Oxy is actually doubling down on this whole strategy. So let's look at what they have planned for 2026.
The plan for 2026 is simple, and it should sound pretty familiar by now. Spend less, produce more. They're going to cut their capital spending by about $550 million, but at the same time, they're aiming to increase production. It's pretty obvious they've hit on a winning formula here, and they're not about to change it. And that hunt for savings, it never stops. They've already pinpointed another $500 million in costs they can cut in 2026. This really proves that these changes aren't temporary. They're now baked into the company's DNA. It's just how they operate.
So I want to leave you with this really powerful thought from Oxy's CEO. She pointed out that right now, the entire global oil industry is only replacing about a quarter of the reserves it uses up. Think about that. For every 4 barrels they sell, they're only finding 1 new one. That's just not sustainable long term. So
In an environment where the whole industry is struggling to keep the shelves stocked, a company like OXY, one that has figured out how to produce more while spending less, isn't just having a good year. They're basically building a fortress for whatever comes next. It really makes you wonder, in this new world, who else can actually pull this off?